Good morning, everybody. Hopefully you had a wonderful weekend. Maybe hopefully a little less snow than we got here in Minnesota. So we got some interesting stuff to cover today. I think will help you with your current clients and prospects. Trouble everywhere. Here's what I mean by that. This global bubble burst, Evergrande set for collapse, causing great reset worse than 2008. So does there anybody here not know who Evergrande is? Good. I'm getting no answers, which means you do know who Evergrande is. Are they the only problem that China has right now? No, that's the tip of the spear. And how much are they going to, how much week by week do they keep pushing out? How much are they pushing out on a weekly basis, debt-wise? Oh, so there's a lot of people who don't know. Evergrande is a Chinese real estate company who's been on the verge of collapse for the last 2 months, and they keep at the last minute finding a way to push out the call on their debt week by week by week. How much is it? 300 million is what they're on the hook for. 300 million, and they're on the edge of collapse on that basically every single week. Now, it's not the empty cities. That's another. Somebody brought up the fact that they were building empty cities. That is a problem, but that's why I'm saying Evergrande is not the empty cities they were building over there. This is totally separate. That's why it's a tip of the spear of problems that they have. And China, what's happened to China's growth? What's happened to China's employment? What's happened to China's inflation? Are they as healthy as they've been? I mean, what's happened to their growth rate? I mean, are they nearly as healthy as they've been for the last decade? Or is it starting to wear at the seams? And does China have the same effect that they had 10 years ago? Or are they now going to have the same effect on the world economy as the U.S. problems would have on the U.S. economy, or on the world economy? China's Evergrande faces 22, I'm sorry, I said 300 million? No, it's 300 billion. Sorry about that. Million. That would be a drop in the bucket. China's Evergrande faces 221 billion. It's now up to 300 billion of debt. And one expert has claimed that the company's collapse could spark the fall of the financial system. Speaking to Express UK, Dr. Margaret Messer, Deutsche Market Screening Agentur, claimed that the collapse of Evergrande is the first domino in the eventual destruction of the world financial system. Due to the size of the property market, estimated at 55 trillion, he claimed the collapse of China's property market would create a worse financial meltdown than we saw in 2008. Guys, 55 trillion is the Chinese property market right now. And again, Evergrande is the tip of the spear. Oh, yeah, Nick says, we don't really know the status of anything in China, so we won't know until it's too late. That's a great point. So is this the only problem we're seeing worldwide right now? No, we've got the supply chain inflation is causing problems. Consumer price index, 6.2% in October. What else do we have happening? We've got Omicron happening across the world. See, and here's the thing, overvalued by almost any measure. Ratio of the S&P 500 current reading to average since 1954. Guys, that's 75 years. 75 years. Household equity allocation, overvalued. Price to sales, overvalued by 100%. Price to book, overvalued. Q ratio, overvalued. Buffett indicator, overvalued. Dividend yield, overvalued. Shiller PE, overvalued. Price earnings, overvalued. But here's the big thing about this. This was done in 2018. Are we more or less overvalued right now than we were in 2018? Much more. So remember, we've talked over and over and over. I've shown you, if you pull out 2 years early, are you hurt? If you pull out 2 years early for the market crash, are you hurt? Okay. How about 1 year early? Are you hurt? No. Bernard Baruch said, you become rich by what? And Buffett actually says this too. Bernard Baruch said, you get rich by what? Bernard, if you don't know who Bernard Baruch is, he's one of the most famous investors the country's ever seen. By not losing, very good, you guys, by not losing money. What's today's indicators? Well, we looked at this here a few months back. Update on valuation indicators. PE, 78%, 88%, 91%. CAPE ratio, 100, 96, 97, compared to 2000, compared to 1970, compared to 1950. Price to dividend ratio, 97, 95, 96. Price to sales, 900, 100, 100. Do we have any, guys, with these kind of overvalues, do we have any room for a blip in financial markets, whether it be Chinese real estate, whether it be a change in the pandemic, whether it be a change in, what kind of elbow room? I mean, I've always said, this is like, we're sitting there with what? We're sitting there with a room with 50-year-old papers, Tinder, sitting in a room with gasoline. And that gasoline can is leaking right now. Does that mean that tomorrow the market's going to blow up? No, it just means that what? How much of a spark would it take to make this thing go? Nothing. So here is the thing that's really concerning to me. These things are absolutely concerning. Oh, and guys, why do I talk about this every couple of weeks? Because the market's doing what? The market fell 600 points, and what did it do 2 days later? It came right back. So we start to get what? Start to think, oh gosh, this is making me nervous. Or because of what happened during COVID and what happened here last week. That's right, Mark. We start getting complacent, saying, hey, I know the market's going to go down 600 in a day. But I know it's going to what? Come back. Is that really how the market works, guys? It does. But does the market really work where it comes back in a month, or the market comes back after 10 years? Think of the Dow Jones chart that we show people. Over 100 years, the market goes up. But over 10, 15 years, the market can go do what? Is 10 years enough for long-term investment, guys? Is 10 years enough for long-term investment based on the last 100 years? No, it's not. It's not. And here's what's really frightening to me, and this is what really means that you got to be concerned about where your client's money is. The best investors do the worst things. The $1 trillion that has flowed into global stocks in 2021 is bigger than the last 20 years combined. So when are people putting the money into the market? At the beginning of the bull market, or at the very, 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 very end of the bull market? I met with two friends this weekend, both highly intelligent guys, but guess where they're putting their money right now? They're not in this industry, but they're extremely intelligent. They're putting their money in the market. And both of them told me they were geniuses because they did it at the end of, or during the drop in 2000, or in the pandemic drop here a year and a half ago. But are they saying, my God, I did a great thing, now I need to get out? Or what are they doing? What are they convinced of now? If the market falls, it's going to what? Come back up. 1 trillion more. Guys, does this frighten anybody on the call? 1 trillion that's flowing in global stocks in 2021 is bigger than the last 20 years combined. That means that means how much money is left to get into the market at this point. See, this is what it looks like. Analyze inflow global stocks. Look at that. Holy crap, holy. Remember, we looked at, this is equity allocation. How many times since 1950, in the last 75 years, how many times has there been a higher equity proportion in U.S. households? How many times? Once. This is the percentage of equities in equity allocation in U.S. households. How often has it been that high? And when it is that high, what happens to the next 10 years return? When it was that high, what happened to the next 10 years return? This orange one here. I'm sorry, the green one here. Zippo, diddly-do. In fact, it was what? -5. And as I've shown you over and over and over again, what is the CAPE ratio saying right now? So this is, CAPE ratio is predictive. This is actually what happened. So when the equity allocation was this high, the CAPE ratio would say that, hey, we're going to average -5 over the next 10 years, which is what it's saying now. It's saying -5.7%. Did that occur? Did that occur here? Did that occur here? Did that occur here? Did that occur here? So when equity allocation is low in the U.S. households, what should we expect? So do we want to be investing when equity allocations are at the highest, when we're seeing this kind of warnings going off, not on one indicators, but on all 100% of indicators? No, I want to be investing when everybody's got out of the market, not when anybody's in the market. I want to be when the equity allocation is at 50 or at 25%, not at over 50%. Because when equity allocation is at 25%, how much room is there for markets to go up at that point? So I'm sorry for constantly harping on this, but I'm harping on it not just for you, but for me. I'm harping on it for me. Why? What emotionally do I want to do constantly? What emotionally as an investor do I want to do constantly? Because I'm sitting on the sidelines with millions in earnings 0.5%, 0.5%. I'm sitting on the sidelines with millions sitting on the sideline. Yes, I constantly want to get in. I constantly want to get in. I have to look at these charts so I don't do something stupid because I want to be part of these people. But guys, we can't do that. We can't let them. And you're their financial coach. So should we be, where should we be? 50-50, 40-60, 60-40. See, and what are retirees' concerns? 88% would like to have enough money for financial peace of mind. Should they be in the markets right now? I mean, should they be overly placed in the markets right now if they want financial peace of mind? How many people want the highest return possible? What percentage of people want the highest return possible? 21%. And when the market goes down, what is this 21% going to say to you as their advisor? Even though they told you they want a high return, and I can support the risk. I can support the risk, Bob. What are they going to say when it actually happens to them? How many can actually support the risk emotionally once it happens? Hey, that's easy in paper. It's easier on your risk test that you give them. But how many can actually support it when it actually happens to them? None. So we need to be concentrating on the financial peace of mind, not on getting the highest return possible. And remember, those of you that are familiar with the FI presentation, your chance of success of not running out of money based on today's stock allocation, where should people be if they want to have the least chance of running out of money over the next 30 years? Where should their stocks be today? What percentage do they have in stocks today? How many of you can read this chart? What percentage? The dark green, this 95% of success, 95% of success, 95% of success. Where should they be? How much? How much? If they have no money in the stocks, they have a 25% chance of running out of money. If they have 100% of their money in stocks, they have a 90% or a 10% chance of running out of money. They want the least chance of running out of money. They need to be here. So 10% chance of running out of money, 5% chance of money. Let's do our math here. What happens to the chance of running out of money, percentage-wise? What happens to the chance of running out of money if instead of having 90 or 100% of their money in stocks, they only have 30% of their money in stocks? What happens to their chance of running out of money? It drops by how much? Drops by how much? Does it drop by 5% or does it drop by 50%? It drops by 50%. Instead of having 90% or 100% of the money in market, if they go to 30%, that's when they're going to have the best chance of running out of money. And do people want the now? If you have 100% of your money in stock, you'll end up dying with a lot more money. Is that what most of your clients want? To end up dying with the most amount of money, or being able to spend the most amount of money throughout every single year of their retirement? So if you want to die with the most amount of money, have 100% of your money in stocks. But you know what a better way? If you want to die with the most amount of money, what's the best way to what's the best investment you can make if you want to die with the most amount of money? If that's your goal, life insurance, that's right. So if your client's goal is to die with the most amount of money, hey, go ahead and put in life insurance. But if they want to have the highest standard of living, should they be at 100% or should they be at 30% right now as we speak, with all the indicators flashing red, 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 all the things that are going on? Where should they be? They should have a much lower response. But Jeff, you've talked to a lot of advisors, and they've talked to you. I know everybody in this call knows this. I know everybody on the call knows that they should have their clients in FIAs, at least 30, at least 60, 70%, at least 50% in FIAs rather than the marketplace. And I know you've told your clients that, but Jeff, you told me that many of our advisor clients still have way too much in the market. And why is that?
Because that's what the client says they want. They say.
So guys, are you order take? I'm sorry, Jeff. Yeah, go ahead.
No, that's it. That's it.
That's what the client wants. So what the advisor thinks says, if that's what the clients want, that's what we're going to do. Is that what you've been hired to do as a financial advisor, guys? No, you've been hired as a financial advisor, because if you let them do their own thing, what does all the research show? If the market, let's just use an example. If the market averages 11 or 12%, how much does the average investor get? 11 or 12%. If the market averages 11 or 12%, what does the average investor get? 11 or 12 or much less than that? Yeah, much less than that. Why? Why do they get much less than that? Because they put money in at the wrong time and they take money out at the wrong time. So it's your job to make sure they don't do that. And our advisor is doing their job when this is happening. Our advisor is doing their job when this is happening. No. It's your job to get them to do this. But that said, whose decision is it? It is their decision, but what is your job? Your job is, as Socrates said, or Socrates, as they say in Ted and Bill's Great Adventure, I cannot teach anybody anything. I can only make them think. So it is their money. They saved it up. They did the hard work. We can't make them do it, but we need to get them to think. So we need to use the Socratic Method. We need to use motivational interviewing. So the example here, what is a square, my friend? I'm not sure. Well, a square is the shape with four sides. I see. What are and then there are only other cute shapes with four sides, or what about a door? Well, yes, rectangle has four sides. So then I suppose, see, you're asking open-ended questions, getting the client to think and to understand for themselves. Do we have any tools for you to use for a client that wants to keep all their money in the market? Do we have tools for a client that wants to keep all their money in the market to have them decide that that's probably not a very bright thing to do? No, not the 21 point. The 21 point, what's the job of the 21 point checklist, guys? 21 point checklist has one job and one job only. What is to kill their advisor, to get them to leave their advisor, not because we say so, but because they say so. Okay, so that's great. You all get that. Then what are the tools we use to get a client to think about where they want their money and decide, I need my money in an FIA? There you go, Steve. That's right, Dave. In the FIA presentations. And we have two of them. We have a compared to bonds, which is about 4 years old. And we have the FIA presentation that's 23 years old and still works perfectly well. Now, which one should you use? Which one should you use? What do you think, guys? Which one should you use? The bond one or the participation rate one? It's a trick question. It's a trick question because you should use the one. You should watch both of these. So watch the video. So watch this hour-long video for the bonds and watch this hour-long video for the FI presentation. And you should use the one that speaks to you. You should use the one that speaks to you. They both have had billions of dollars of monies moved from the stock market into FIAs, not because you told them to, but because the client told them to. This participation rate has had tens of billions of dollars moved into FIAs from the stock market. Probably close to $1 trillion in money moved over the last 20 years. This one has had billions that moved in the last 4 years. So they both work. You should use the one that speaks to you. Now, here's the question. How do you know you've done a great job on the FIA presentation? It has nothing to do with whether they move the money or not. It has nothing to do with it, because if you do it right, if you do it poorly, sometimes they move the money. But if you do it right, all the time, 100% of the time, they move the money. So you can't make the point that if they move the money, you know you did it right. Because sometimes when you do it poorly, they're very powerful presentations. You guys have very powerful personalities, so you can get sometimes people to move whether you did the presentation well or not. So there's nothing to do with that. What way do we know that we have a 100% chance of them getting to move their money? If I listen to a tape, how do I know, even if I don't, how do I know, even if you don't tell me if they moved the money or not, that they moved the money? Mark's got it. How many open-ended questions over the 60-minute presentation did you make? How many open-ended questions should there be? Minimum. 1. And again, guys, we had an answer. They should be angry with your advisor. Is that the job of the FIA presentation, to be angry with their advisor? When should they have been angry with their advisor? At the end of the 21. This is where they're telling you where they want their money, how much of their money they want. And guys at Jeff, when somebody does this right, what percentage of their money does a client's money, what percentage of their money does a client want to put into an FIA? When you listen to tape after tape after tape over the last 20 years, over the last year, how much do they want to put into them or have?
All.
Yeah. All. Not 50%. They want to put what? All of it. And the reason I'm saying that, Jeff, is we had some answers that said 50%. No, all of it. They want to put all of it. And then it's your job, then again, to do what? As their financial coach, to do what they want. Now, we can't do that anyways because the insurance company won't let us. But your job as a financial advisor, say, listen, this is a great tool to use. It's not the only tool to use. So what we want to do is make sure we have a portion of our money, what? Protected. How much do we want protected, guys? What percentage of our money do we want protected right now? If our clients want peace of mind, unless they're 80 years old, unless they're 70 years old, but if they're in their early 70s all the way back to 60, how much do they have in FIAs right now? But Nick's got it. What percentage? If we want their peace of mind, not 50%. You're right. Most of you are getting it. 70%, because they should have 30% of their money in the market now, 7% guaranteed if they want financial peace of mind. If they want to have their money grow and turn over as much money to their children as possible, they should do what? Have 100% in stocks, or they should what? Buy life insurance, as we said earlier. Does that make sense? So as a poll now, please type in for me, which of these, how many of you are using the bond? And I want everybody to do this. Either put bond or participation rate. You can say par. Put bond or par. Tell me which one you're using. Wow, it's about, thank you guys. It's an even split. So you seeing that, Missy and Jeff and Jerry? It's about an even split. So guys that are doing the par, does it work just as well as it always, as it has for the last 23 years? When you do the par, do people move the money? Everybody's saying yes. And guys, when you do the bond, do people move the money? Yes. So the one you should use is the one that speaks to you, because they have, one's a little bit more story oriented, one's a little bit more fact and figure oriented. You should go with the one that you love, that speaks to you, because both of them work perfectly well. Go with the one that fits your personality. Does that make sense? And how good should you be doing it? Well, you should be good doing it so that when you tape yourself with a client, you should be asking at least one open-ended question per minute. So you should be listening to at least over a 60-minute period, that presentation, at least 60 who, what, where, why, when, how questions. Now, here's the great thing. There's recall, there's recognition, and there's relearning. So which one requires the most work to get back to a great presentation? Recall, recognition, or relearning? What requires the most time and effort to get back to where, relearning. We don't want to do relearning. So how do you remember what you study? Well, and there's a name for this, and I can't remember the scientific name, but this has been, there's tons and tons and tons and tons and tons and tons of research been done on this, that the percent of stuff remembered 10 minutes after class starts to do this. Look at 10 minutes. There's an exponential fall off on what you remember 10 minutes after class, a day after class, a week after class, a month after class, a year after class. But guess what they found out? That if you just do 10 minutes after class, you do a quick review, it brings you back up to 100, and then what happens to that? If you do another quick review the next day, what happens to your retention? Then if you do another quick review a week later, this is what happens. If you do another quick review a month later, guess what happens? And that's those of you that have learned the 21-point checklist using the Anki software, the ANKI software, guess what that's using? Dave says he loves Anki. This is what it's doing. Anki actually is a software that we have. If you ever want to learn the 21-point checklist, we have Anki for you to do that. It does this for you. It knows, the software knows that you haven't reviewed or you got something wrong the last time you answered it, so it puts you back into this curve again. So that it knows, oh, you got that right, we can push you out to 24 hours later. Or, oh, you got that right 24 hours later, we don't have to re-quiz you on that until a week later. Oh, you got that right week, we don't have to re-quiz you until a month later. But guys, if you want to be doing the FIA presentation, it's the same thing for that. We don't have an Anki for that. Oh, somebody's asking what Anki is. If you don't know what Anki is, call Matt at ECA, and he'll get you started on that. It's software that uses this chart to have you learn the scripts for 21-point checklist and master that, ANKI. So this would allow you to learn the 20-point checklist using this methodology, this research. And this is a huge branch of memory research that's been going on for the last decade. So this has been proven over and over and over again. We don't have Anki for the FIA presentation, but my point here is with the FIA presentation, how often should you be reviewing it? You should master it. Once you've mastered it, you should review it that day. Once you've mastered it, you should review it the next day. And then once you've mastered it, when should you review it again? So you learn it backwards and forwards, review it again that day, backwards and forwards, next day, backwards and forwards, and then when should you do it next? Jim Quick talks about it, but he didn't invent it. He's just a guy who regurgitates stuff. Then when should you do it next? One day, and then if you can still do it perfectly the next day, when should you review it again? When should you review it again, guys? 1 week. Good job. Good job. And then if you do it a week from now and you just can go back with just boom, 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 not even thinking about it, you're still awesome at it, when do you need to review it again? A month. And then you should do it how often going forward? Every month. Put it on your calendar every month. Once you know the 21-point checklist, backwards and forwards, do it again later that day. Do it the next day. Do it a week later. And if you're still awesome at it, now if you're not awesome at it a week later, guess what you need to do? Go back through this process again. This process only works as if you're awesome. 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 But the great thing is once you get awesome at something, how much work does it take to stay, guys, how many presentations do I do? How many FIAs do I do? How many bond FIAs do I do? How many participant races do I do? How many 21-point checklists do I do? How many, I don't do them that often. But guess what keeps me completely fresh? I do them what? I do all the necessary presentations what? Take a wild guess. How often do you think I do the FIA bond and the FIA? That's right, I do it monthly, Steve. That's right. And by doing that, my life is really simple, because if I waited until I forgot, I have to do what with this chart? If I don't do it, and I say, well, I had COVID, so I didn't keep, and I get it, guys, I totally get it. I'm just trying to make your life easier. If I didn't practice any of these things during COVID and forgot them, now I have to do what? Because to get to this point, how much work does this take? It takes a lot of work to get 100% memory. It takes very little to keep 100% memory. It takes a lot to get 100% remembered. It takes very little to keep 100% remembered. If you want to learn the periodic table, the chemical or the element periodic table, how much work would that take? Or if you want to learn Spanish, how much work does that take? But once you learn it, how much does it take to maintain that knowledge? Not that much. But if you don't touch it for months at a time, what's going to happen to that? Goes down a little or a lot, and then it requires a lot more. So if you haven't learned the FI presentation, please go back and learn it, and then put it in your. Should you trust that you'll remember to practice it 24 hours later, practice it a week later, practice it a month later, or should it go into your calendar? Guys, many people say, Mike, I wish I was disciplined as you. Missy can attest to this. She's known me for 22 years. Am I a disciplined person, Missy? No.
You are not a very disciplined person, sorry to say.
Guess I'm all over the place. Guess how I keep disciplined, guys? The ADHD is right. I have ADHD. How do I keep disciplined? That's right. I put it in, I don't count on Missy. I put it in the calendar. In the calendar. She is my mommy, but still. She would have quit a long time ago if I relied on her for too much stuff. So for this kind of stuff, I put it in the calendar, and it creates a habit. When do I do my 15-minute drill? Sometime during the day or at the first thing in the morning? First thing in the morning. When do I practice the bond presentation? I do it on the 3rd of every month. When do I practice the 21-point checklist? I do it the last Friday of every month. So when do I do those things? I put it in my calendar. Because if I don't do it and I trust myself to do it, it can go all sorts of time periods, and then I'm forced to go back and relearn things. Does that make sense? So doing this will make your life easier. Please go back, learn the FIA, then go back and do it for your clients before it's too late. Because when the market starts to go, and when the market goes, does it go down 600 points and then back up, 400 points and then down 800 points and back up 200 points, and then, it has a rally and it comes right back to where we started again, and then it falls 1,000 points. I mean, how does it do it? Let me see if I can find, just a second here. I don't want that. Just a second, guys. I want to show you something here. If I can find it here, bond presentation, and we'll do slideshow. I just want to show you one thing. And I'm gonna have to go, there we go, that's what I'm looking for, or am I looking for that? Oh, that's what I'm looking for. Guys, how does the market fall? It falls, no, it comes back. No, it falls, oh, it comes back. No, it falls, it comes back. Oh, it falls, comes back. Oh, it falls. Guys, 17 years, market did nothing. Oh, it falls, comes back. Oh, it falls, comes back. 11 years, did nothing. You guys lived through this, and yet we've forgotten it, right? Falls, comes back. Oh, I better get invested now. Falls, does nothing. Guys, look at this. 18 years, 25 years, 17 years, 11 years. And right now, we're at all the dashboards are doing what? Flashing, we are way overbought. So can anybody time the market? No. So I'm going to call this call early because I would like you all to take the next half hour to go do two things. Go back, look at the FIA presentation, decide out which one you're going to get awesome at. Quiz yourself. Do it. Quiz yourself. See how good you're at it. And then let me get out of this one here. And then use this chart. If you're awesome at it, just put it in 24 hours later. You're going to review it again tomorrow, and then put it in your calendar a week later. And then put it in your calendar for the next 12 months. Every single month you're going to review it. If you're not awesome at this, guys, we're in December. This is a time when a lot of guys are not as busy as they normally are. Learn the 21-point checklist. Use Anki, which will help you do that. Learn the FIA presentation. so that you can, and then put it into your calendar, into your physical calendar, so you maintain awesomeness at that. Does that make sense? Don't let the client dictate how much they're going to have on the market, what they're not going to have in the market. Please, 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 you are their advisor. They count on you to help them not make stupid. And right now, there are tons of people making what? Stupid decisions. Okay? Help them do the right thing. Make sense? So take the next half hour, go back for the 21-point checklist, for the FIA presentation, and get that stuff put in your calendar so that once you learn it, you don't forget it. All right? Appreciate all you guys. You guys have a wonderful rest of the week. We'll talk to you all next Monday. Thanks, everybody.